hills and her driveway is really slushy and she didn't know if she could get to her office, and her home computer is not fast enough. So she will not be here. The commissioners probably will not be here because there was the tragic fire at DCI. At least there were no lives lost, but they are holding a meeting out there at 10 this morning to talk about that. And so they will, more than likely, none of them will even attempt to get to this meeting. Jim, do you know anything about how many employees they had out there or anything?
You know what, I don't know for sure. The news report I saw said around 100, but I can't confirm that.
Oh, okay. I didn't know. So that's a lot of jobs.
Yeah.
And I understand it's temporary, but what do people do temporarily while they're not working to pay the bills? It's for our county, it's a big tragedy, just like it was when the creamery burned down in McMinnville last year, or was that 2 years ago? At any rate, that's what they're doing. And I don't see Ken here. I see Mike and Kevin. There's Ken. There he is. Okay, so the question is, so we have 5 members of the committee, and I believe we have 7 total that are on the committee. So therefore we have enough to have a quorum. And so I'm going to proceed hi, Kevin. Morning. So I'm going to proceed with the meeting because I know that everybody has many other things to do, particularly Ken and Mike, who I always appreciate having here, but I don't want to belabor this meeting so that they got big goings on here at the county. Nothing, there's no, what is that? Rolling stone gathers no moss. Well, there's no moss at the county. So to start with, I will get the agenda up here. And now this is always interesting for me. Share screen. Okay. That is not the agenda. Nothing. There's no, what is that? Rolling stone gathers no moss. Well, there's no moss at the county. So to start with, this keeps happening to me. I've got to go the agenda up here. And now this is always interesting for me. Share screen. All right. This happened to me last time too. You guys bear with me here. Okay. That is not the agenda. Okay. How's that? Are we better now?
Yep.
Okay. Thank you. We don't need to hear me twice. Okay. So here is the, are you guys seeing my whole desktop? You are, aren't you? I don't like that. Okay, now you're not. All right, so the agenda, we have welcomed everybody. We have next. Okay. Some days are just like this. So we have the investment committee minutes. And I don't know if anybody had time to read them, but do I have a motion to approve the minutes?
So moved.
Thank you. All
Second.
Okay, all in favor?
Aye.
Aye.
Okay, thank you. We will move on. So this is the look of 1982, which is what working women looked like in theory during that time. And this is the last time inflation was as high as it is today. And like that fashion, this too shall pass. This is I would say a temporary, we don't have to look at her. This is a I think a temporary meaning it's going to take a couple of years to recover. It's not like it's going to go back to normal in a month. But I wanted to talk a little bit about, and these, just so you know, this kind of presentation is really, even though you're all on the committee, the presentation is to some degree tailored to the commissioners, because they, of course, are very concerned, and sometimes they are not, as because they have other things they're doing, not up to date on what's going on in the economy. I know that everybody in this group understands, but I'm going to talk about it anyway. The CPI, as you know, went up to 8.5%. There are so many factors that go into that current cause of inflation. And you could argue all day about what all goes into it, because depending on people's politics or their current place in the economic world, they have a different experience. And so therefore they have a different idea about what causes inflation. But the fact is we have it. And the Russians' invasion of Ukraine, of course, has affected the oil and gas tremendously. And that is an ongoing problem. That is not going to go away as long as Russia is in Ukraine. So we can expect that that will continue to drive up. And if you look at the increase in energy, just in the last 12 months, it's over 30%. And that is a direct reflection of the oil and gas situation in Russia. Food prices, which have gone up, a little less than 10%, it's about 8%. That also, those would have gone up anyway, but is also an effect of the war in Ukraine. The Ukraine produces a lot of grain, they make fertilizers, and they're not being able to produce affects the entire world, because they do export a great deal of commodities outside of Ukraine, which then increases the prices overall, which will actually probably be, unfortunately, a boon to our local farmers, a lot of who produce grains, and the prices will go up. So locally, we might benefit a little from that, but the food prices that we're all paying, of course, is still going to go up. Another issue is the tight labor market, and the tight labor market is a mystery to many. And one of the challenges with the hiring right now is the fact that once again, a bunch of baby boomers and some even younger have decided we're just not going to work anymore after the COVID pandemic. And so, and a lot of those people held fairly high positions in many companies. And so there is not just a hole in the lower income levels, but broadening throughout the labor force. And this, once again, it's not going to be a quick fix. Another challenge for the labor market, particularly here in Oregon, is that we rely, speaking of agriculture again, we rely heavily on immigrants to do the farm or the agriculture work that is done here in the Valley. And there has been a great reduction, in spite of what people believe, a great reduction in the number of immigrants coming into the state, and the available people for that agriculture work is down, and there's nobody to replace them, and even paying higher wages is not a solution. So that's a big drain on our local economy for the farmers, and they living on an island that is a farming island, that's the topic of conversation, is how do we, what happens if our crops just fallow in the field because we can't get enough people to do the work? And that is a big draw on our economy, but it also increases inflation because there are, of course, people who are making more. Now, the average wage increase over the last year is about 5.5%, but you have inflation at 8.5%. So the workers are in fact not keeping up with inflation. And if we raise those rates, of course, then we have, the spiral of inflation. So that's an issue. Automobile price have increased mostly because of the supply chain disruption that has occurred, but that is softening. It's getting a little bit better. But my experience is these price increases probably are going to stick around for quite some time, both with new vehicles and old vehicles. I mean, you have lists now to buy a car, which was unheard of a few years ago. And in some instances, people are just really jacking up the prices. People are opportunists, and they also have to pay their rent. And if they can only sell 3 cars instead of 100 cars, they need to make more money on those sales. So that isn't just price gouging. It's trying to manage their income. And then we have increased housing prices and rents. Now, one of the things, and Jim would be intimately involved in this, but one of the challenges for housing prices is that mortgage rates have gone up they're above 5%. Well, what happens when mortgage rates go up that high is that people decide, I'm not going to sell my house. I've got a low mortgage rate. I'm going to keep it. So there is a reduced availability of inventory on the market. And that will, if the rates continue to go up, that might become even more difficult. And then, of course, the opposite, the flip side of that is the people who are not in the housing market and are trying to buy houses are going to have a harder time buying them. You would think that would dampen the market, but the supply is just too lean. And we have outside investors who are snapping up the entry level homes and turning them into rentals. And the rents have not seen the kind of increase that I think they're going to see. I think they're going to see really high increases over the next year to 2 years that are going to make our homeless and our housing shortage even more of a challenge than they are already. And lastly, because COVID is over, people are increasing their travel. And that once again drives up prices as the people who are trying to make up for what they lost during COVID are raising their prices in order to get back on their feet. So we have overall what we've got is a combination of Ukraine, supply chains, and COVID all hitting the economy at once. And it's going to take a while for this all to settle down. And I don't know. Some people believe, I've read just yesterday, believe that inflation has peaked. And there is optimism in the market that this is it. And it's going to start to go down. And so today the market went up, bond rates went down. Everybody's just really happy with what they saw. And the reason they think that is that many items on these lists didn't go up as much as they had gone up the month before. So that's a nuance that would be lost on anybody who's actually having to pay those prices. So anybody have anything to add, since we have all these experts here on board, about inflation and what they think is happening? Disagreements?
Yeah, well, and I may have missed something. So we also have 72 million millennials in their prime home buying years, which is adding to the stress on the housing market. When I look at that list, I think supply chain disruption and fuel is driving a lot of that list. The interesting thing, with your comparison to 1982 is that and I had to look this up, I didn't remember it, but at the end of 1982, we were in a recession with 10.8% unemployment. And that's a very different factor now. So it would be interesting to see how that combination of factors plays out over the next 6 months or so.
Yeah, you're absolutely right. I did the same kind of research in preparation for talking about this. And And a couple of things that in 1982 was the end of a recession in many ways. And so the inflation rate has been higher. Hopefully we don't experience the same thing. 82 was not the highest. It was just the last time we hit this level. But the millennials, they're just being squeezed. They are really being squeezed between rent and now with mortgage rates going up and the price of houses. I mean, I'm so glad that I'm a boomer and not a millennial. Sorry, millennials. So what happens with this is that we have really volatile interest rates. And just to show this, I took a 5-day period that ended on the 13th. And the 3-year note, which is really what I consider to be our benchmark, is in 5 days, it changed constantly. And it went up to maybe a high of looks like maybe 2.8 something and a low of a little below 2.6. Well, that's, here's the range. There I am, 2.579 to 2.8 is the range. And for the year, it's 0.265 to 2.817. Now, people who are managing cash flow and bond investments like I do, and like Jim does at the bank, certainly, have had to deal with this incredible swing on rates and trying to make guesses as to how long term to go. We're in a window of 1 to 5 years allowable, which isn't long, but it is for us at 5. And as just to look at what's happened, and the current rate at the time of this was 2.625 when I printed this, and today it is 2.3. So it's crazy out there. It's really crazy. So one of the things that people are talking about is this is the yield curve on the day I printed this, which was probably, I don't know, the 11th or so. And it starts at the 1 month and goes out to the 30-year. And this is a year ago, and this is today. Well, now the rates are higher in the mid-range, on this mid-range, which is the low end here. But the difference between this point, which is 3-year, which is what we invest, and the difference between 30-year is minuscule. Now, this is not an inverted curve, but it did reach inverted curve level a couple of times over the last month. And an inverted curve is simply where your normal maturity yield, is that this is what a normal curve might look like. Well, an inverted curve looks like this, and a flat curve looks like that. I would say we are closest to being a flat curve, if you can have a curve that's flat, but it's flat. And it's anybody's guess long-term what that means and what causes that. Some people hit the panic button because if you go back historically, you'll see that whenever there's an inverted curve, it precedes a recession. As Bill mentioned, there are so many different things going on right now than previous times that personally, and I'm not an expert, I don't think this is anticipation of a recession. I think this is simply a result of confusion and regarding what the feds are going to do. The people don't want to invest long term if the interest rates are going to go higher, and they just really don't know what to do. So it drives the price up. People want something more attractive. If the current rate is 3% for a 5-year bond and it's 2.7 for a 3-year bond, well, what do you do? And that's what I look at every day is, well, do I want to go out to this 5-year, or is that 5-year going to look really low after the Fed is finished. The people believe the Fed could raise rates as high as 2 percentage points over the next year and a half. And so the rates are going to go up. But I do think that the anticipation of the rates going up is built into the current rates. And so so I think that even though rates may go up, I think there will become a point where the self-realization of the actual rates may cause it to steady a little bit. Now, I know you guys have opinions about that. So what do you think?
I'll chime in. I think, really in the last week or two, it's been that the spread between the 2 and 10-year treasuries been inverted at times. And I think that, that might be signaling that people think the Fed's going to overdo this and push us into a recession. So there's no need to worry about the 10-year rate getting higher compensation at 10 years than 2 or 5. I think the question is where's the curve going to pivot? If it shifts, will it pivot at the 5-year point or some other point? But generally, when my recollection, when rates are flat like this, it entices you to go short, but really you should go a little bit longer and lock in the rate. But I don't know. There's the economy's clipping along really, really strongly, and what's driving that, as you said, the demand, but it's also a lot of easy money, free money from the Fed. A lot of stimulus spending is driving this. You take mortgage rates that were at 2.75 and now they're over 5%. That's going to really slow things down. And the question is, the Fed continues to talk about transitory inflation, but the thing that's not transitory is the wages, and those are going up rapidly. As you said, 5% was the average. There was some talk. That's kind of the minimum. When you have people at McDonald's paying $20 an hour to get people in the door, that's highly inflationary, and it's not going to go away. When farmers' cost of fertilizer doubles, and if they're growing wheat, they might be able to get $12 a bushel instead of $8. But are the grass seed farmers going to get double for their grass seed this year? Probably not. So I don't know. It's we're in a interesting point. I don't have a crystal ball and wouldn't, but I think that there's a lot of risk right now that the Fed overdoes their correction here.
I think so. Yeah. Anybody else? Thank you, Jim, for that input.
Yeah, I would just share, Chris and committee, that at NEPC, we have changed our dynamic tilts and what we're recommending to clients a bit, just recognizing greater risk of a recession. It's still not our base case, but we think that risk has gone up a bit. And now obviously we're investing in other asset classes besides fixed income, but in the fixed income space, we are allocating more capital to the short and intermediate term space. We've had kind of an underweight to fixed income for a while, but just recognizing the increase in yields that we've seen, starting to build back to more of a normalized position there. And I think, it's been a rocky start to the year in fixed income, but over the long term, if you're earning more yield on your portfolio, that'll certainly be a positive for the county, especially if we see inflation start to moderate. I do agree with Jim that wages tend to be stickier. You don't often see, if people are getting raises, that's harder to reverse. And so that could contribute to some more persistent inflation.
Thanks. So moving on from that, first of all, I wanted to share, and that's not what I want. Where'd it go? That's not what I want. Well, anyway, I wanted to talk a little bit about some of the resources that I have available to me, and I was going to show you some of those, but for some reason or another, now I've got everything but that up. We don't care about that. Care about that. Okay, well, forget it. But what on a daily basis, I do check the Wall Street Journal is a great source of what rates are doing, and they have some really good market pages that are live, and so you can see exactly what's happening on the day. If I'm buying a bond this morning and I see that the rates are starting to trend down, I will likely buy that bond in the morning. But if I see they're trending up, then I'll wait. It doesn't make a big difference overall in the portfolio. Maybe it's just a game in my mind, but it makes me feel better. So there's the Wall Street Journal. There is some really great information on Bloomberg. There is great information on, I follow the Treasury and the labor. Anyway, so I was going to show you all those cool pages, but I'm not going to now. So I'm going to do this a little bit out of order. The broker dealer review is complete. And by the investment policy, I need to do this at least once a year to go over the people who we invest with and who give us information recommendations. And these are the brokers I'm dealing with. And I'm really happy with this group of people. They're very responsive. Several of them, particularly Piper Sandler and Finding Sparks, send me wonderful morning updates on what's happening out there, and it's a great start every day. So I don't know if I need to get your approval to continue, but let's just say I do. So could someone move that we accept this list of brokers, and we can vote on that?
I'll make that motion to accept the broker list.
Thank you.
Second.
And all in favor?
Aye.
Aye.
Thank you. Opposed? I should ask that. So anyway, so they're a good group. They have very different styles. I like dealing with them.
Chris, I had one quick question on this, and this doesn't change my approval at all, but just since you have specific traders listed here, what happens if somebody resigns? Do you have to update this list, or?
I would have to update it because we approve not just the firm, but the actual broker.
Okay.
So yes, I would have to replace that person in that firm.
Perfect.
Yeah.
Okay.
And
Just want to confirm. Thank you.
thanks for the question. Yeah.
Chris,
So-
could I ask a question as well? And I
Yes.
know you covered this before, but could you just reiterate that you've run FINRA background on all these folks and they're clean?
Yes, that's what I did. I did FINRA on both the individuals and the firms for my review. And they all came out clean as a whistle.
This is Mike Barnhart here.
Yeah.
4 of them I've worked with. They're very involved with the County Treasurers Association. Josh, Alan, Nolan, and Mark. I've known them for, I don't know, nearly probably 15 years now. They're all very involved, which is good because they're shared by other counties in Oregon. So if we had a trouble or someone else had a problem, we would hear about it.
Yeah.
So.
Yeah, that's where mostly this list is derived from input from when I made it, from the other treasurers, like who do you use? And because I started this list basically from scratch, they all have a little different emphasis. And Mark Walker from Morton Capital is really a good source for municipals. And so I look to him whenever I think, well, what are municipals doing? And Alan Schnall, who is somebody that Mike recommended, is
I apologize now.
he
He's
Yeah, he's got a different personality. And
he's
he's there.
yeah, he's great. He gets you good deals, but my goodness, you got to deal with his constant calling.
Oh, he's really aggressive in his sales. But that's okay. I can deal with that. I was a broker once. I get it. So anyway, so that's our list. And I have no reason to add or subtract from that list, but if somebody came along that really I thought could add something, I would consider it. I think this is plenty, and we're lucky to have those people. So the next thing on the item and on the agenda is the investment policy clarification. And we'll go back to the review of the portfolio. When I was reviewing the investment policy, and it's really it's not a significant difference, but it says that we could buy something up to 14 days before settlement. And I wanted to change that to 10 working days, because there are times when there are days in a 2-week period that, we could have 3 days off. And so, that would detract from our ability to do 10 working days. So it's really not a change, just a clarification. But in order to do that, is there any discussion on that? Okay. So all those in favor of that clarification? Oh, somebody want to, thank you. And everyone in favor?
Aye.
Anyone opposed? Okay. I'm going to move ahead, as I said before, to Clearwater transition progress. We have been working with Clearwater since the middle of March. And what I quickly discovered is that they're a big company and they move a lot slower than we do. And so they have a formulaic response to a transition. And that response is what includes multiple people. And so they don't move it on to the next person until this person's done, and this person might have 10 things to do, so they don't do it right away. So it's a frustrating process. They have a calendar, and they're going to stick by that calendar no matter what. And their calendar says that we will be up and running by the end of May, which is fine for us for our fiscal year, because we have plenty of time the end of May, to then carry on for next year. But they have I simplify things. I'm not a backroom person that has to deal with all the minutia. And so I was a little disappointed and frustrated with how much minutia they seemed to add to what to me is a very simple process. But we're moving along. I still am excited about it, but it has been slow. Any questions about that?
I'll just toss in there, and working with their project manager has been difficult. I mean, I've seen many emails from you, Chris, explaining that he's not very effective.
No. And so I, in fact, the one thing that Mike has probably observed is that I'm really nice until I'm not. And then I have put some pressure on them to make certain that we have somebody looking over his shoulder, so that our project he's brand new to the position. So they said, oh, let's give the small account the new guy. And my sense is he probably won't be new very long, because he's not going to last. So they've added a very knowledgeable woman who's actually the manager for the area, who is now working on our account. So it will get, and Joe, the previous guy, is still working on it, but he gets so nervous, and he's such a poodle, or I don't know. He just, it has not been a good match. Now he will only be working on our account until the full transition is made, and then we'll have new people. If I thought I had to work with him, we'd have to reconsider the whole project. So anyway, any more questions or?
Chris, once it's up and running, then you won't have to deal with this more challenging person anymore. Is that correct?
That's correct, yes.
Okay.
Yeah, and if they did assign this person, then I would make demands that be changed, but that's not his job. His only job is the transition.
Okay. And
And-
then once you're up and running, then will you have another, kind of ongoing relationship person that you can contact if you have any questions or trouble or?
Yeah, I will. And,
Okay.
and I kind of think that given that I have been vocal with them regarding this, that they're going to probably make certain they give me somebody who it's not their first day on the job.
Good.
And, so, I used to manage 200 people and I was not hesitant to call people on the carpet because, I'm sure Jim has the same concerns at times, really nice people, but they're not doing the job, they're in the wrong job. So you move on. Okay. Any other questions about that? All right, so we are now to the portfolio review, which shouldn't take long because that's the minutes. Oh, here it is. Okay, so as we've discussed at length, the rate trends have been pretty crazy, and then this was the inflation rate was only 7.9 at the end of March. But if you look at, we had inflation of 1.4 in September of 20, we had 2.6 just a year ago. So that's a huge change. And the rates that are being paid out, LGIP did raise their rate to 0.55 in March and then again to 0.65 since then. So we are getting more money from LGIP. And our bond portfolio, as you can see, has gone down in return because the higher yielding bonds matured and we were forced to buy bonds at the time when the rates were, if I could get 40 basis points, it was a good deal. And and I had warned the committee that this was going to happen, that, we were going to continue our rate of return. It was going to go down and it has, but it has started to go back up a little bit. And it will continue to do that now, but slowly. And so it's actually higher than if we look at the earnings trends. We had predicted that we would earn 591,000 in the fiscal year coming up. And I think we'll find that it is higher than that, which is good. Not as high as it was back in 18 and 19 when it was at its peak. And I don't know, part of this, if truth be told, is because we had some lower quality, longer term bonds than our actual portfolio allowed. But no harm, no foul, it worked. So the earnings trends, as you can see, have been dramatic change. And, since it's on my watch, it's like, oh my God, what am I doing? But it's just the way it is. So we've got, in the portfolio, as we agreed last time, we have raised the percentage allowable in bonds, and I have done that gradually, simply because it's not a good idea to dump everything in the market at once. And I've just about reached where I will for a while. And so we've increased primarily agency bonds and US Treasury bonds, and we're still well within the limits to those sectors. And in terms of, and you can see down here, you can see this little visual chart, which I think is always helpful. And the dividends that we earned in the third quarter for LGIP, it was only 42,000 and bond interest was 49. But our accrued interest at that point was 129. So we're going to get already, that we're going to get more in the next quarter. Part of this is because I'm buying bonds that didn't pay interest yet since we've owned them. The ARPA funds, which are in fact very misunderstood by the public, I would have to say. Initially, at the beginning of the year, we had 10 million, and some of it has been used for the cities, which they're very grateful for. And we received $10,000 in dividends over the last quarter for that. And then as of the end of March, we had 5.5 million, but that level, there has been some payment out of that account since then. And so, oh, look, Katie's here. So we have had some use of those funds. So that I think is at like 3.5 million around there. And that is being, right now, the commissioners are looking at the bulk of that will go to nonprofits. And they have a very solid plan for how to distribute that. And that will happen probably, I don't know, Ken, you think that's going to happen in the next month?
That's a great question. I know decisions are still being vetted and haven't been finalized yet. So we have another discussion tomorrow. So I'm not sure the timing. I'm also keeping an eye on, because we should be expecting our second tranche from U.S. Treasury coming next month. So we can't distribute more than what we have right now.
Right.
So that's something that's also going to have an impact on timing on how quickly we're able to release those funds.
Yeah.
The total water and sewer infrastructure was right around 6.8 million. It has what has already been approved and released. So I'm keeping an eye on the timing of any future release of funds for grant programs, because it's going to be subject to when we get that second installment from U.S. Treasury.
Yeah. I think that, and I'm only saying this because all of you are part of the public. There's a big misunderstanding out there in the public about what these funds are allowed to be used for, what the process is to use them, how challenging it is to meet all of the requirements for those funds. And so there's been a lot of people kind of making political hay out of the fact that this process has been going slower than what they hoped, and that, their favorite coffee shop isn't getting any money, and that's not what this money is for. So now if people talk to you about it, since you're on the investment committee, you can explain to them that is actively being reviewed and plans are being made.
Chris, how long is this, are we anticipating we'll receive funds from the government given this plan?
I'll let Ken address that.
We're only expecting the just over 21 million, almost 22 million. So we received the first 10 million last May, and we're going to receive that second half next month, and that's it.
Okay.
So this is a one-time American Rescue Plan Act funding, and it's a one-time funding, a one-time investment. We're not anticipating any other, barring something coming out of Congress, but this is it under this specific category.
Great, thank you.
And all the cities have gotten money as well, which they also can designate to use within the guidelines as well. And so it's not just the county. If the county chose to do so, they could use it without benefiting the cities directly. They could do something else with it, but they have decided, because the cities are in such need, to add to the funds the cities have to make a bigger impact on those cities, which is something that I support completely. Not that it matters what I think, but I do.
Well, and I would just add that, as part of the updated treasury rules, the county could have made a decision to take 10 million of it, call it revenue replacement, and transfer, that to support, the services that we do provide. But we haven't done that. In fact, the numbers on what we have identified at this point, 70% of that funding is going to go out to water and sewer infrastructure, nonprofit grants. So 70% is right now targeted to support programs outside of the county via grants. So, and you're right, the city's also got a direct allocation, but our investment, specifically what we've made available, is specific to water and sewer infrastructure. So that's what the cities, they applied for, and they have projects that have been identified. And then I would also add that the state of Oregon also had a direct allocation of ARPA funds that came to the state, and the county is in receipt of an additional 2.2 million from state ARPA funds to help support rural broadband infrastructure projects. So that's something that we're also working on. So that's an additional 2.2 million that the counties received for that specific targeted use as well. It's not going to show in the ARPA allocation because I'm trying to track those separately because they have different reporting requirements. But that additional 2.2 million is going to show in another area of the budget and be available for supporting those types of projects.
Thanks, Ken. Anyway, so now you know as much as Ken knows. You can speak with confidence as people ask you these questions. Moving on to page 4, we have the bond investment summary, which is the current market value, rounding, is 34 million for our bonds with a cost of 35 million. And so we have an unrealized loss of $1 million. Now, those of you who manage investments realize that that is only going to be a loss if we sell those bonds. Now, the actual par value of those bonds is actually just a little less than 35 million, the par value being what we would actually realize at the maturity of those bonds. So there is no real loss. And the par value is a little bit lower than cost because sometimes we purchase bonds at a premium because we earn more interest. So it's not really a loss, but it is a amortized amount of money over a period of time. And we have not had the ability until we go with Clearwater to show that amortization clearly in our books. And so when let's say a bond that we paid a 2% premium on matures and we only get 100% instead of 102, it looks like a loss, but it in fact isn't. But once we get this new ability, it will not show up as a loss. I'm boring Mike, he just yawned. So anyway, so the monthly income, though, the estimated is 489,000. And that will go up as we buy more bonds. I think we'll definitely be at 500,000 for the 12-month income off of the bond portfolio. And the yield on market is 1.44%, which is up from where we were. And every time I invest, I immediately look after the item's been posted to see how it affected our yield. And if we get up 1 basis point overall in the portfolio, it's like, okay, we're headed the right direction. And the average weighted maturity is 2.58 years, which is right where our target is for this portfolio. And the average credit rating is still AA and will continue to be so because I am not buying anything that is lower than AA. And so that will not only will that AAA, AA that we see in the bond ratings will probably at some point in time be, the two combined will be 100%. So the investment policy limit, the way we've set it now, I could invest up to, based on, and this is the Lucy part of it, is based on the overall portfolio size. At this time, I could have invested up to $42 million in bonds, but that size goes down over the year. So I can't really invest that full 42 million. I currently, I probably will top it out at pretty close to 35 to 37 million in terms of investment in bonds, so that we don't hit a point where I got 70% in the bond portfolio simply because we have less cash. And I'm trying to time maturities, if possible, to mature in the months of the summer where we have less cash. And so we don't need bonds to mature in December and January when we're flush with cash. So it's a new way for me of looking at those maturities now that it's tighter. So that will be my goal going ahead. And we've already reviewed the benchmarks, and there's the comparison. Are there any questions on that?
Chris, one quick question, and I know I'm newer to the committee, so my apologies if this is kind of something everyone else knows, but for the LGIP assets, the current yield is about 55 basis points, which is close to the 3-month treasury. And I was noticing kind of back in 2020, when the 3-month treasury was very low, the LGIP was paying out 1%. So I'm just trying to understand what's driving the rate that the LGIP will pay.
LGIP invests in, just like we do, in various bonds and various maturities. And so they experienced the same challenge that we have, that as rates went down, their portfolio went down. And so now they raised it to 0.65 now because they're realizing some of the benefits. And their portfolio is more liquid than ours. They can sell things if they choose to do so. They have, it's a more active portfolio. They don't have to hold to maturity. And
Are they in the stock market as well, Chris?
no, not LGIP, no, but the funds that are for the retirement plans, they are, yes. LGIP is strictly bonds. And so they are, in fact, if anybody is interested, I can send you out their investment policy that guides them. It's pretty much the same as ours, except for they do have this trading capability, and they're dealing, of course, with huge amounts of money because the money is coming in from all over the municipalities all over the state.
Right.
Yeah, so
718 total.
sorry.
Katie's not muted.
No, Katie, you might want to mute yourself. Anyway, so does that answer your question, Stacey?
It does, and I would, if it's not too much trouble, I would love to see the investment policy just
Okay.
because better understand that.
ready?
Thank you.
Yeah. Yeah. I can mute Katie, can't I? I'll mute her. All right, she's muted. Okay, so yes, I can send that out to you. And I have burrowed down on the internet far enough that there is a place where you can actually, I believe, see what they're holding, which is kind of helpful, because I think the quality rating for them is a little lower than it is for us. And, they could just take more risks, not that they take risks. And they have really good experienced people managing that fund. I am comfortable with that.
Mhm.
And the biggest thing that happened at one point for all of the people who manage public funds, this is probably 15 years ago now, probably the last time we had big changes in interest rates. A lot of people started investing a lot lots of money into callable bonds. And then when the rates went down, they found that their bonds were called away. And all of a sudden you had all of these people all over the state that didn't have any place to put their money, and they had to quickly buy bonds at lower rates. And it really interfered with the projections that the municipalities had for their income for that year, because they were getting 5 and all of a sudden they were getting 3. Those are mythical numbers. But so that's why we have a limit, as does LGIP, and what percentage of callables we could have in our portfolio to eliminate that kind of swing, potential swing when interest rates are
Got it.
volatile.
Great. And Chris, I think I found on their website their policy, so
Okay.
I've got it up now.
Okay.
So thank you.
Okay. Does anybody else want it? I think Stacy's our only real policy wonk. Thank you, Stacy. I appreciate it. So, any other questions on this page? Nobody feels like I lost $1 million for the county? Okay. So this is our portfolio maturity, and it's fairly heavily weighted in 24 and 25. And part of that is because, once again, and I'm not real comfortable investing in 26 and 27, because at this point, I feel like those rates are not real firm. And I unlike Jim, which is not that I disagree with them necessarily, but I've been a little bit more confident investing in the shorter term bonds. Because it is my belief, based on what I read, that by the time we get to 2024, when these bonds mature, interest rates will be higher than they are today. And so then I can lock in better rates. But that's my crystal ball. We certainly are well within our maturity constraints. Any input or questions about that? All right. So, and then callable bonds, this is one of those things that I can't get a list easily from Zion's about our callable bonds. They just don't track it. They have to do cartwheels in order to get me a list of what's callable and what's not. So I haven't updated it for this report from where we were before, but then I haven't bought any more callable bonds. So I know that we're well within the percentage that we should have, but it's still interesting to look at what could happen if all of our bonds were called at the time that they could be called. And there certainly would be a big influx of cash that would come in this 0 to 12 month period if they could be called. But in fact, I don't think that anyone's going to call anything with the current rates. Any questions about that? It's frustrating not to be able to buy callable bonds, because I could raise our return by 50 basis points across the board if I invested only in callables, but that risk is there.
Chris, are any of the investments like within the agency bonds in particular potentially floating rate, or are they all mostly fixed rate?
They're all fixed rate.
All
Yeah,
fixed rate.
I don't buy floating rate.
Okay.
And I don't buy, and I had this discussion with Kevin earlier on, and I don't buy tips either. It's our goal is simply to get a good rate of return and be able to predict it for planning, rather than increase the return a little or whatever, but not be able to predict it. And we also, if we buy, I really try even not to buy things at a premium, because what I want is the actual rate of return. I want to know. So I try to buy close to par so that we can really predict the cash flow. Money manage, in my view, managing a portfolio for an institution like this is very different than managing a portfolio for profit or for individuals. Simply because this is, as I've said before, this isn't really our money. We don't have this money. This is money that's come from grants, and it's all has been, we have it now, but it's all accounted for. So it needs to be really conservatively managed. If we ran out of grant funding tomorrow, you would see the assets dwindle quite considerably. And of course, the county couldn't function. We need our grants. So the assets purchased, as you can see, I did buy almost 10 million. And they're all really dull. Are there any questions about any of these purchases? At the time that I was buying some of them in February, I thought 1.625 was just incredible return. And now it's not. So that's what happens. And so my goal during this time period was to get at least 1.5% return off of any new investment. That has since changed. The assets matured, called, or sold. These are all matured. I didn't sell anything. And so we had $1 million, a little over $1 million, 1,000,001 that matured over the quarter. And we did realize gain. This is the flip side. If bonds are purchased at a discount, obviously we're going to get more money back than what we paid for the bonds. But so we did have a gain of 16,000 off of these. But the important thing to remember is that we haven't been able to amortize this appropriately. And Mike is going to take care of that. I think did Mike disappear? He did. He probably had something else he had to do. It's a very busy time.
Yeah, he sent a chat message that he had a 10 o'clock meeting.
Okay. Oh yeah, see, it's 10:02. So then here's our Oracle bonds, and this is the last thing we'll talk about. These are still below par. I mean, below what we want in terms of credit quality, and nothing's changed with them, and they will mature this year, and then we won't have anything at all on our credit watch list unless something really dramatic happens. In the meantime, we're earning a good rate of return off of them. So that is the entire report. Do we have any questions about that?
Good report. Thank you.
So our next meeting is at 9 a.m. on July 13th. And do you all want to continue to do Zoom meetings? Does anybody have an interest in meeting in person? Let's put it that way.
I prefer Zoom.
I do
It
too.
Works for me.
Fine either way.
Yeah.
Either way for me.
I think I don't even know where we would meet if we met in person, because there's not a lot of spaces in the county for a group that would end up being 10 people. So for now anyway, for this next meeting, I would like to recommend that we continue doing Zoom, unless there's an objection to that. All right.
Great.
Anything else? Any comments to round up the meeting?
Thank you.
Sorry, we ran 3 minutes over. Sorry about that. Okay, well, with that, I will adjourn the meeting. It is 10:03, and I will see you all. If I don't see you around other places, I will see you all on July 13th. And thank you again for participating in this process. I appreciate it.
Thank you, Chris.
Thank you,
Thanks,
Chris.
Chris.
Nice job. Bye. Bye, everyone.
Bye.